So why actually pull back on your forecast when it looks pretty strong? In fact, it looks even more robust looking ahead as the comeback that China's actually undergoing seems to be gathering momentum.
Yeah, absolutely. I mean, iron ore has been one of the best performing commodities over the year to date, given how strong Chinese economic recovery has been post-COVID, and these steel-intensive sectors, including real estate and infrastructure, massively outperforming. Now, the issue is over the summertime period, which is typically a trough season, we've actually seen major year-on-year growth in steel demand, which has resulted in restocking of steel mills for iron ore, and that has pulled iron ore prices towards its highest level in 4 years, alongside supply disruptions coming out of Brazil. Now, as we move ahead into the peak season, it seems the market started to get a bit skeptical about the sustainability of Chinese steel demand, and therefore iron ore prices, which is now very high relative to its cost of production, in the scale of $30 to $70, is due for a pullback, given the very stretched valuation.
Tracy, the thing is, if you look at copper, there's even more caution surrounding that particular metal as well. Why?
Yeah, we've seen copper also being one of the outperformers in the metal complex, propelled by speculative longs all the way after COVID. And if you look at the positioning data and you put a 1 to 10 scale, speculative net long is probably close to 10 out of 10. So the positioning being stretched, and we're kind of ahead of that major uncertainty around the US presidential election. A lot of the investors, they decide to take the risk off the table. Also, similar concerns around the sustainability of the Chinese demand into the rest of the year. So we think in the case of copper and iron ore, a lot of the pullback in the near term could be temporary. We're actually quite constructive copper for next year, expecting prices to bounce up to an average of 7,000. In the case of iron ore, we don't think prices will go back to the high levels we've seen, given the relative prices versus producing costs. But we do think prices will remain at around $90 per ton next year, which would enable major iron ore miners to have another good year on their revenue.
Tracy, how much of China's policy support has been factored into all these forecasts that you're giving us?
I think the market has been sort of well broadcasted with all the China's stimulus measures so far. If anything, recently we've seen a marginal deceleration in these credit expansions, and also some early signs of property restriction policies across different cities, which are kind of new to the market and just started to be digested, and hence the near-term pullback. But the major swing event is the upcoming fifth plenary session in late October, which could set stage for China's growth target for the next 5 years. So if in that plenary session, the growth target come out above expectation and major stimulus policies are announced, we could see an easy switch back of that positive sentiment.
Of course, we've seen data out of China coming out pretty encouraging. What's the risk of an easing of China stimulus, and what impact would that have?
So I think currently we're looking at a very strong China and slightly weaker ex-China from the trough we saw earlier this year, right? So going to the next year, even with China's credit momentum easing a bit, if ex-China managed to catch up, thanks to the broad-based QE and fiscal packages being announced out of different governments, if that were to pan out, then a lot of the strength ex-China would be able to offset the second derivative weakening of China easing. So in that case, we're looking at a pretty tight physical market. In the case of copper, where we're putting in 300,000 tons of deficit next year, given what I said about the demand projection, which enables copper to trade higher for longer. So obviously, if China were to disappoint again, then you're kind of back to that roughly balanced market to even a small surplus in the market, which would potentially pull copper prices back to the low 6,000 or even lower.
Tracy, if relations between Australia and China worsen, what are the likely implications for base metals if, for instance, Australia stopped sending base metals to China in retaliation, arguably, for a move by Beijing?
The two key commodities being affected here are coal and iron ore. We have seen early signs of the delays in cargo clearance of Australian coal and to a lesser extent iron ore. And in fact, a lot of that congestion is sort of applicable to sort of cargo from other countries as well. So it's hard to say whether this is geopolitically related or it's a generic port congestion. But in any case, if China were to restrict imports of iron ore and coal from Australia, these would be very supportive of domestic prices of both commodities, putting pressure on the seaborne prices. So we have seen that very much in thermal and coking coal so far this year, where the price gap between domestic and seaborne market could be as wide as $30 to $50 per ton.